Good day. This is Milton Flanagan with Flanagan Financial Services. Death taxes, Medicare surcharges, and corporate taxes. How many of you think having $1 million or more only pertains to a very few? If you're 65 and say you have savings between IRAs, 401ks, 403bs, deferred comp plans, life insurance, stocks, bonds, mutual funds, your house, or any other type of investment, their value today could add them all up and could be between $750,000 and $1 million or more. Probably not hard to fathom in some cases, since your home could be worth between $150,000 and $350,000 or more. If your investments grew at about 3.5%, over 20 years you could have more than $1.5 million. I know, just said he's nuts. He's lost his marbles. That's probably true. My wife tells me that all the time. Okay, hear me out. The current president's potential tax policy may cause you to lose more of your money to taxes. Here are some ways he has discussed about having you and your family potentially pay more taxes. He's discussed lowering the current death tax, estate tax, some estimate to between $3.5 million at the federal level. You say, well, that's well above $1 million, but did you know that Illinois' estate tax is anything over $4 million today? That's roughly 35% of the federal level. If they lower the federal level to $3.5 million, then Illinois, if they kept the same percentage, would be about $1.2 million. And which state is broke? Again, why tax dead people? Well, most of the time they don't vote. 2, raising corporate taxes anywhere between 25 and 30%. That's between a 20 and 50% increase in the current tax rate. Again, corporations do not pay taxes. They include the tax in the cost of their goods and services that you purchase. Potentially a rise in these costs means less money in your pocket. Now, in Illinois, Governor J.B. Pritzker is also planning on raising corporate taxes. If you're receiving a pension and have money in a 401k or invested retirement accounts or just invested in the market, what do you think will happen to the value of your account if the companies you invested in don't keep earning at least what they were earning the current year? There's a good chance your account values could drop, possibly by 20% or more. If you're interested in products that could assist in potentially preserving your retirement income, please give me a call. 3, there are also other tax increases that they're considering. Capital gains taxes, increased in payroll taxes, elimination of the pass-through credit, wealth tax, and more. Number 4, modifying the Medicare surcharge brackets. This is an easy one. Right now, roughly about 10% of the people on Medicare pay this surcharge. But remember, Medicare, by all counts, as early as 2024, is out of money. All they need to do is tweak the brackets to include more people, and voila, they've collected more money. With the potential new tax increases that are being considered, it is potentially possible that someone could pay federal taxes as high as 50% of their income. When you add in high-tax states like New York, New Jersey, and California, taxpayers could end up close to 60% or more. Don't forget the higher costs from increased corporate taxes. Now maybe you get to keep even less of your money, and with higher gas prices, may mean even less money in your pocket. Now, maybe more than ever, tax planning and death tax planning are important, since it appears that we might be regressing back to a Jimmy Carter style of era of tax policy. Tax planning efficiency might be even more important. If these taxes aren't bad enough, what happens if we have a recession? We might be up the proverbial creek without a paddle. So ask yourself, would you like to potentially keep more of your hard-earned money, potentially pass your money and your property to your family, church, charity, or give it to your good old Uncle Sam in the U.S. government? If you're inclined for option 1 or 2, then we might need to discuss your situation and begin developing and implementing plans that might be able to achieve those objectives. The current president campaigned on having higher taxes retroactive. Some believe that there's not enough time to do that in 2021. But if it doesn't happen in 2021, there's a high probability that they will happen in 2022. And not planning now could cost you. If you're interested in learning more or want to have more of a discussion, please call me at 630-235-5273, or you can email me at Flanagan, that's F as in Frank, Lanagan, at FlanaganFinancialServices.net, and we can discuss your situation in more detail. This is Milton Flanagan with Flanagan Financial Services, and you have a great day.